Dividend stocks have rallied sharply in recent months, especially the high yield space. You can see that with the Schwab US Dividend Equity ETF, or ticker symbol SCHD, has performed quite well. Other tickers like DIV or SPYD, which are more high yield stocks, have done quite well. REITs have led this charge, as the Vanguard REIT ETF VNQ has done very, very well. Utilities, as depicted by ETFs like XLU, have done very well over that period. Infrastructure like Brookfield Infrastructure Partners or Brookfield Renewable Partners, especially Brookfield Infrastructure Partners, has done very well in recent months. And certainly alternative asset managers, which manage these real estate and utility infrastructure businesses like Brookfield and Blackstone and KKR, they've all done exceptionally well as well. So, the yield space, the dividend space is doing great right now. However, there is one sector that has not participated in this, despite me thinking they should. Actually, there are two that haven't participated. One of them is business development companies, but that's understandable. I've explained in other videos why they don't do as well in an environment where the Fed is pivoting to cuts as opposed to hikes. You can look up my other videos on BDCs, and that will explain that deeply. I'll link to one of them in the video. But before I get into the sector that is not participating that I think should be, if you could please give this video a like, it greatly helped me get its distribution out there and help me grow my channel and be greatly appreciated. Thank you very much. Okay, so the sector that I think should be participating in this rally but isn't is the midstream sector. And why is the midstream sector not participating? Well, it's because, yes, there's growing expectation of a Federal Reserve rate cut, but part of the motive that's driving that expectations for rate cuts in past months and now resulted in the 50 basis point cut and driving further expectations of rate cuts is, yes, inflation is moderating. It's coming down, but it's still a little bit elevated. And what is really driving the outsized pace of cuts, as we just saw in the first one with the 50 basis instead of 25 basis points, which I personally expected to be 25, that's what I thought was warranted, is that there's growing concern of a recession. And the Fed has a dual mandate to keep full employment, pursue full employment, target that, but also try to keep inflation at or even a little bit below its target rate of 2%. And so they're trying to keep those in balance, but unemployment has been rising quite significantly over the past year. And so the Fed is leaning more heavily on that side of the mandate. And so if the economy were to go into recession, that's expected to hurt demand for energy because less economic activity. And so that would likely hurt oil prices and midstream. And while midstream is largely immune to short-term swings in commodity price volatility, that many of them have a little bit, maybe 10 to at most 20% exposure, the vast majority of their cash flows are contracted or regulated, which means that in the near term, they're not really susceptible to energy prices. As long as their counterparties are able to honor those contracts, they're going to get their cash flow. Over the long term, when it comes to renewing contracts and dealing with demand for their infrastructure, sure, commodity prices matter, but a short-term recession wouldn't really hurt them all that much. Meanwhile, with interest rates dropping, the same principles that have driven REITs higher, utilities higher, and other high-yield stocks higher apply to them. Namely that they're viewed largely as bond proxies because they pay very high distributions, they have long-durated stable cash flows that are comparable to bonds or preferred equities. And so when interest rates are coming down, the market should expect less of a yield from these midstream entities. And so therefore their unit prices should rise, their stock prices should rise so their yields can drop accordingly. But that's not happening. And I think that's a major missed opportunity. I think the market is unfairly penalizing these companies because of the increased pessimism about the state of the economy, even though midstream businesses are quite defensive in the face of recession. Just look at how many of them performed during the 2020 COVID crash. They actually performed quite well, and only a few had to cut their distributions, and that was because they were over-leveraged. But today, their balance sheets are all quite strong, especially the investment-grade ones. And so I think that this is a major missed opportunity. And in today's video, I'm going to talk about three that I think are particularly attractive right now. The first one of these is Genesis Energy, and ticker symbol GEL, and it's a smaller midstream. It's not as well known, but they've just completed a major CapEx spending profile. They have these projects coming online in the next several months and quarters. Their CapEx is dropping precipitously, and that's going to result in a major inflection point for them. As their spending drops and their EBITDA rises from these projects coming online, they're going to have a massive amount of free cash flow that's going to be pouring in. And that's going to give them enormous flexibility. They've already said they're going to be buying down some of their preferreds. They're going to potentially pay down some debt to further strengthen their balance sheet. But that's already in pretty decent shape, and it's only going to get stronger. And they're going to be able to use the extra free cash flow to either buy back units if they remain cheap and or to grow their distribution. In fact, this past quarter, they hiked their distribution by 10%. And they said that's just probably going to be the beginning. In fact, I think they could very easily and probably will over the next year or two or three probably maybe 1 or 2 years, but maybe it'll take up to 3 years. Just depends on how they want to approach things. They could double their distribution from its current about 4.6% level. And so we're looking at a likely close to 10% yield on cost within a few years from a business that will have low CapEx. They don't vision really having CapEx pick up anytime soon. They've largely they're happy with where the business is. They're going to run it for cash into perpetuity, maybe make a few occasional strategic investments and acquisitions, but it's going to be just let it run. And they're going to have a very strong balance sheet and just be able to grow that distribution. So I think that's a very attractive opportunity right now to buy before it gets away from you. Another one that I really like right now is Energy Transfer. And this is one that I've held in the past. I made a lot of money off of it. I bought it in late 2020 after they slashed their distribution, rode it all the way up till early this year. And it's largely floundered since then. And I think it's a good opportunity now because with rates dropping, my estimate of intrinsic value of it has gone up. They're continuing to execute very well. Their debt is now at the low end of their target leverage ratio. They're going to be growing their distribution at 3 to 5%, I think closer to 5% annualized CAGR for the foreseeable future. They yield over 8% on a forward-looking basis. They have one of the lowest EV to EBITDA multiples in the entire midstream space, despite having a very well-diversified and growing business. And so I think that's a very attractive opportunity right now. The third one that I really like right now is Western Midstream Partners. Now, they have an over 9% yield. It's like 9.2, 9.3% distribution yield. That's well covered by distributable cash flow. And they're probably going to grow at about a 2 to 3% pace, so it should be able to keep up with inflation moving forward. Their EV to EBITDA is under 9 times. They have a very well-run business. They have a 3 times-ish leverage ratio, one of the lowest in the sector, investment grade. Management has proven to be very prudent in allocating capital, buying back units opportunistically on the dip, paying out a hefty regular distribution, and giving a special enhanced distribution at the end of each year, depending on when their leverage ratio is. So that's another bonus. So their yield is probably going to even be higher than 9.2% in many years. And to top all that off, their primary counterparty is Occidental Petroleum, which is a quality counterparty to have, gives a lot of contract stability and visibility. They have long-dated contracts right now. And Buffett backs Occidental Petroleum. So even if Occidental gets into trouble, Buffett owns a huge amount in the company. He would probably backstop it pretty well to keep it afloat. Otherwise, he'd lose a huge investment there. And that would make the contracts for Western Midstream pretty safe. They have other counterparties as well, that like ExxonMobil and others that are high quality as well. So there's a lot to like about Western Midstream. I think it's arguably the safest and most attractive 9% plus yield in the market today. So there you have it. There are 3 high-yielding midstream opportunities that I think should be priced a lot higher than they are, and I think they will outperform the high-yield space moving forward. I think the market is missing on this one. And so if you like this video, if it added value to you, if you could please let me know in the comments below what you liked or maybe what you'd like me to do better next time to help me make this content better for you as I continue to invest time and effort into this channel. Also, if you could please subscribe to my channel, I would greatly appreciate that because I need it to grow to be able to get these videos to a higher audience and ultimately make it worth my while to keep making these videos. And if you haven't yet, please give it a like as well. That helps this video get higher distribution as well. Thank you very much. See you next time.